August 2024, a month of sweltering heat and chilling economic news. Japan, the world's third-largest economy, saw its stock market take a tumble. The Nikkei 225, Japan's equivalent of the Dow Jones, dipped sharply, a clear signal of waning investor confidence. The reasons? A potent cocktail of domestic and international woes. Japan's economic engine, heavily reliant on exports, sputtered as global demand weakened. The once mighty yen faltered, making Japanese goods more expensive abroad. Add to this a burgeoning national debt and a rapidly aging population, and the picture darkens. This wasn't just a blip on a screen, it was a tremor felt throughout the interconnected global economy. When a giant like Japan stumbles, the aftershocks are felt far and wide. Across the Pacific, the U.S. stock market, ever sensitive to global cues, reacted swiftly. The Dow Jones, the S&P 500, and the tech-heavy Nasdaq all shuddered. Fears of a global economic slowdown, fueled by Japan's woes, sent investors scrambling for safety. The U.S., while not directly reliant on Japan for trade as it once was, still felt the heat. Japanese investment in the U.S., a significant driver of the American economy, slowed to a trickle. The specter of a global recession loomed large, casting a long shadow on Wall Street. The ripple effect was undeniable. U.S. companies with significant exposure to Japan, from automakers to tech giants, saw their stock prices dip. The interconnectedness of the global economy was on full display, for better or worse. The cryptocurrency market, that volatile Wild West of finance, wasn't spared either. Bitcoin, Ethereum, and the rest of the digital asset brigade took a hit as investors, spooked by the traditional market turmoil, pulled back. Crypto, often touted as a hedge against traditional market volatility, proved to be just as susceptible to global economic chills. The allure of quick gains faded as risk aversion became the order of the day. This wasn't the first time crypto danced to the tune of global events, and it certainly won't be the last. The nascent digital asset class, still finding its footing, remains vulnerable to the whims of the broader financial world. Section 4. A blast from the past. Echoes of crashes past. The events of August 2024, while unsettling, weren't without precedent. History, that wise old sage, offered a sobering reminder of past market crashes and their global repercussions. The 1997 Asian financial crisis, triggered by a collapse of the Thai baht, sent shockwaves throughout the world. The 2008 global financial crisis, sparked by a U.S. housing bubble, plunged the world into the worst recession since the Great Depression. Each crisis, unique in its own right, underscored a fundamental truth. The global economy is a complex, interconnected web. When one strand weakens, the entire fabric is at risk. Section 5. Safe havens in a storm. As investors weathered the storm, certain assets emerged as safe havens, ports in a turbulent sea. Gold, that age-old symbol of wealth preservation, glittered as its price climbed. Government bonds, particularly those of the United States, attracted capital seeking safety and stability. The US dollar, the world's reserve currency, strengthened as investors sought refuge in its perceived stability. These safe havens, while offering protection, weren't without their drawbacks. Gold, for instance, offered no yield, and bond yields remained historically low. But in times of uncertainty, preservation of capital often trumped the pursuit of returns. Section 6. Looking ahead. Uncertainty and opportunity. The Japanese stock market crash of August 2024 served as a stark reminder of the fragility of the global financial system. It underscored the interconnectedness of global markets and the speed at which shocks can reverberate across borders. As the dust settled, questions lingered. Would Japan's economy recover? Would the US dodge a recession? Would the crypto market stabilize? The answers remained elusive, shrouded in the mists of uncertainty. Yet, amidst the uncertainty, opportunity beckoned. Market downturns, while unsettling, often presented opportunities for savvy investors to acquire undervalued assets. The key lay in discerning temporary setbacks from long-term trends. The global economy, much like the markets it fueled, was in a constant state of flux. Change, not stability, was the only constant, and within that change lay both risk and reward, challenge and opportunity.